Principles of Finance, a la Shmup. Who gets what? Okay, where are we? We're here. We're the analyst at a private equity firm, LBO/MBOing Blade Runner Nanodrone. It was a tiny dream having started in this guy's garage, only to have grown to become the most dominant publicly traded drone company in the world. Way back when, Blade Runner acquired Nanodrone, a small but scrappy competitor powerful in Latin America. Then growth slowed, Wall Street fell out of love with the company's stock got cheap, and it was bought by the private equity firm of The Agony and the Equity for $1.4 billion, with $150 million of the firm's own equity in it, $50 million from management, $500 million of the company's own cash, and then $700 million of debt to complete the MBO. Well, the company has been flat for 3 years in revenues, profits, and other metrics, while it upgraded and updated its factory and came out with a new underwater drone. Huge excitement now from the investment community about how big this underwater droning can be. So the company goes public for a second time after having been taken private, and the stock rockets. The numbers are kind of simple. Wall Street is telling you that the company is worth, in the form of the $200-ish a share that they're paying for its stock, a lot. Yeah, they're telling you what it's worth. $200, what they're paying. So BRND came public at $60 with over 50 times oversubscribed demand and was a rocket ship. Given the trigger of the green shoe, the right of the underwriting investment bank to sell more shares in the IPO than originally planned as the base case, well, there are now 35 million total shares outstanding, and at $200 a share, that's a market cap of $7 billion. The company has $700 million of debt and $300 million of cash to give it a net enterprise value of $7.4 billion. Note that the enterprise value reflects the cost to replace the entire enterprise, not just the equity. That is, the enterprise value of a house is whatever you paid for it, i.e. the down payment of $100,000 plus the debt, i.e. mortgage of $400K. That house has an enterprise value, of $500,000. Its equity value to you, however, is $100,000. Get it? Got it? Good. All right. Well, there are also a bunch of stock options that employees were granted in this latest IPO of the company. They will vest into them and dilute ownership about 10% over time, but will generate cash and tax losses for the company as those options are exercised and then sold into the market. So while there are 35 million shares outstanding at this moment, there are another 3 million or so options with an average strike price of $50 out there. So if all were exercised, well, there would be, on a fully diluted basis, 38 million shares outstanding, but also another 3 million times the $50 each strike price, or $150 million more in cash generated from the conversion of those options to being shares for the company. And there would also be a tax loss generated in the form of the spread from the trading price of the stock, at $50, $60, to where the strike prices converted options into shares. So if the stock were forever flat at $200 a share, well, that'd be $150 a share times 3 million shares, or a whopping $450 million in tax losses generated by the conversion of those options, as the IRS essentially counts those options as being compensation. Just a normal cost that gets deducted against profits. Yeah, go figure. So if BRND was in fact profitably paying taxes, there would be a value of, say, 30% tax rate against that $450 million in tax losses, or a value of about $150 million in tax-sheltered profits against which the company would pay no taxes, courtesy of their generous option grants to key employees. Well, as the television flashes Kramer yelling about some hair care product on CNBC, and a funky monkey dances over the BRND stock ticker as it flirts back and forth with the $200 line, the senior partner who told you, the naive young analyst, to not sell to Apple for the $1.6 billion they wanted to pay in the middle of the IPO, yeah, he walks by your desk. Well, I'll just say it. Don't you feel stupid now? And you hang your head, thinking for a moment that your career might in fact, despite this great financial victory here at the firm, be pretty much over and dead. Well, the now expected 5 $5-ish or so billion of gain would trigger the 25% carry figure instead of the $90 million you overly conservatively wanted your firm to make on a sure thing with Apple. Well, now they're going to make more like $1.25 billion. That is, had you taken the offer, the firm would have collected $90 million in profit participations spread among the 5 partners and other key players. You, in theory, would have gotten about 10% of that figure, or $9 million, or about $6 million after tax. Not great wealth by Silicon Valley standards, maybe, at Google, but decent money enough to buy a small home and have a few bucks left over as a cushion. So that was you in your overly conservative, child of a school teacher mindset. But now, with the stock at $200 a share, your firm stands to make $1.25 billion in profit participations or carry. Same 5 people and change split it, just massively bigger pie to split. And you wonder openly if you'll still be getting anything close to that 10% or carry. You gulp, almost unable to even think about it, that you, not even 30 years old, would, 6 months and change after this hugely hot IPO of BRND, after the partners sold, be getting a check personally for, some 20, 30, 40, maybe $100 million or thereabouts and change. Life-changing, incredible compensation. Well, you tried desperately to convince yourself that you earned the money, and note that you did work evenings and weekends regularly. By being just a little greedy and patient, you stand to have made 12 times as much as you would have in the Apple scenario. Fear had won in the wrestling match in your brain. You vow to never let that happen again. But then you look at the stock screener ticking by with $200 flashing green on it, and you wonder about the awesome things you learned in this shmup finance course. One of the most important being that nothing trades at 100 times earnings, ever. That is, a given stock may look like it's trading at 100 times earnings in a rearview mirror, but then the street is expecting massive earnings growth. So on next year's numbers, that stock's trading at more like 30 times, and the following year 15 times, because they're expecting earnings to grow massively. Well, like a typical hypergrowth stock might have almost no debt and very little cash and have trailing earnings of $1 a share and trade for $100 a share, but then that company would be expected to be generating $3 a share in earnings in the current year and maybe something like $6 a share the following year, something like that anyway, such that the $100 a share divided by that $6 a share in earnings is a reasonable, close to what the overall stock market is trading multiple of high teens, low 20s, somewhere in there. Something such that, you can do the math and glean that if in a finite decade or two, if the company was flat on earnings, investors would at least get all their money back and probably a bit more, right? Not crazy. But you know the inside numbers of BRND, and it ain't the above story at all. BRND has trailing operating profit before interest costs of $115 million, and you take away about $30 million in net interest costs to, pay the rent on the bond. BRND still has $700 million in debt, but has $400 million in cash. It pays a lot more rent on the debt than it makes on interest on its cash, so it still has net debt costs. Add in a few more cash expenses for factory service and other, quote, being public, unquote, expenses like filings and more lawyers and all that crap. And roughly, you figure that BRND has real pre-tax earnings of, give or take, $75 million a year in cash earnings. Since losses from employee stock options are likely years away from kicking in, because the employees first have to vest into the options and then decide to sell them, well, the company has only modest tax shelters at work, so they do pay real cash taxes, and those taxes then eat another say $20 million of cash earnings from the company. So after everything, BRND has about $55 million in real cash earnings, and it has 35 million shares outstanding. So that's a trailing earnings of 55 divided by 35 there. It's $1.57 a share in earnings. At $200 a share, the stock trades at something like 125 times earnings. But you remember the schmuppy watchword whisperer here that nothing trades there, right? So that means the street must be thinking that next year, the company must earn like maybe $5 a share or more. That would be earnings of $5 times 35 million shares, or earnings of 175 million-ish. And the next year after that, it must earn something like $8 a share, or about 300 million. Well, at those levels, then yes, today BRND is in fact worth what the street is dreaming of it achieving 3 years later when it's trading for $200 a share. But you keep staring at the sales figures you're getting as reports from Salesforce salesforce.com, and your gut tells you that the tidal wave of sales that the street needs to continue to keep paying $200 a share for your stock, well, those sales, they ain't happening. For a fleeting moment, you wonder, can we sell a ton more stock at these prices? I'd happily dilute myself 100% at a $7 billion cap, take the money and run. And then you see a little old lady being interviewed by Kramer on TV. She's so happy. She bought 100 shares of BRND at the $60 IPO price, and she just made 14 grand. And Kramer asks if she's gonna sell and get new dentures, and she says, no way. Silver Slack's analyst says the stock's going to 1,000. I may buy some more stock here. And you muse, and it's the environment of a casino, and that would be great if this really were a casino, but it's not. This is the place where people invest for retirement, for real things of value, not for a wild night's entertainment like it's Vegas. So what is going on here? You know you shouldn't sell more stock at these prices, but already you can hear the senior PE guys strategizing with your bank about doing the secondary offering in 6 months. They'll dump all their shares onto the market, take their huge gains, and run. Audibly, you can hear yourself expressing concerns that BRND will vastly miss its expectations toward the end of the year, that you realize you have a 144A restriction on selling your own shares until 6 months and change after the company's been public, but you feel like you, quote, just know, unquote, that the company will miss numbers badly at some point here in the near future. The masses just aren't buying the Thunder drone like everyone thought they would, and you wonder if you should purchase one yourself and have it get to work digging a grave for your once promising career.